Good day traders, Stacey Burke from Stacey Burke Trading. Continuing our discussion yesterday on average daily range and median price levels. And also we'll just look at the weekly cycles as well. So yesterday we talked briefly about using the average daily range in part of our projections once the market's open, possibly of areas where the market could move to, but also heading into each equity session, particularly after the London has traded and into the US, whether or not we maybe have already met or exceeded the daily average range. And we talk about, four simple things really: the high and the low of the session, the equity opens, waiting for the equity opening times or near the equity opens, then also using the round numbers, 50s and zeros, and then the 12 candle rule. And one of the things that's important with the average daily range and the average weekly range is it gives us possible areas of where the market may continue to move towards, or if it's already reached that limit, may into the next equity session possibly have a reversal. So we're just looking at the British pound, and if we go back to the beginning of the week, so for example, the British pound, our average daily range is 100 pips. This is, that over 10 days. I just use the number 10. There's no particular reason why. You can use whatever number you want. And I've just rounded these out, 250 pips for the week, 100 for the daily cycle. So if we head into the equity session, we used a couple of examples, the high of the day, low of the day example. In this particular case, the Asian range printed between the 25 pip increments. And the other example that we used was when the Asian range prints around a number, and we call that median price. And with this, we can project possibly plus or minus 25 pips on either side as possible areas where the market may move towards or reverse off of. And on Monday, we also had the previous week's high up here. And again, the market, we want them, the smart money, to show us their hand. And the other thing that you need to grasp out of this is we're not trying to trade every single move. We're looking for some setups that match our criteria. We're going to get more and more specific with this, but I want you to focus on these simple concepts because, number one, this is about staying out of the market. A lot of the movement in the market is designed to trap you into positions in the wrong direction or into an area where the market may reverse out of quickly before they move it back quickly to the other side and put 25 to 50 pips into our position. And ideally, we want to be positioned into that move when it moves quickly the other way. So on Monday, we have a calculation in our head of an average daily range of 100 pips. Well, heading into the close of the US session, obviously we have only moved 50 pips. But you'll notice this, and this is the other thing I want you to focus on. Into the end of the US session, we did not have a pullback consolidation into the range. We had a continuation of this move down into the next day, at which point we now had 1, 2, 3 levels of drop. I'll just put this back in here. Sweet spots, it's popped off the screen. So we've moved 75 pips down from the high of the week, but we've actually moved almost 100 pips down from the high of Friday. So these are the things you want to be looking at when we head into each session. So we have median price, and we talked about this yesterday, marking off the high and the low. And when we have median price, we want to look at the quarter levels that are on either side of this box as potential areas where the market can reverse out of. The market came out in the Europe changeover, London Open, and moved very quickly up, almost 75 pips. Now we talk about using round numbers. On Monday, we were inside of the 50 box high, and you can see the market hit it, it hit it, it hit it, and then it dropped down to the double zeros. They've dropped it 25 pips below the double zero box before they went back up and hit the stops from Monday's trade. So again, just focusing on round numbers equity opening times, but looking at the average daily range as possible areas for turning points for reversals or continuations. Now again, obviously the daily range was not met at this stage, but when we calculate and we see 1 level, 2 level, 3 level, 4 levels of drop, that's 100 pips from the high. We're possibly in an area where the market may turn, and obviously we're 25 pips underneath of a double zero area. So 25 pips typically we've talked about this previously, typically will be the range of movement as a false extension on a weekly high or low. And as we start our Monday to Friday cycle, this is now currently the low of the week. The market moves up. Next day again, our Asian box is consolidated around a number. That's our median price. Our median price means that's the middle. We do not want to be caught in the middle of this. Not to say that you can't sell off this level or buy off this level, but we do not want to be trading the swings inside of this level. What we want to look for is a high or a low that's exceeded, and then we look at plus or minus 25 pips. So in this particular instance, when we identify that level, we notice that the previous day's low is underneath. Now, what you need to understand about these levels is that traders have gone long off of this area. That means that there are stop losses. In this area, there's break-even orders in this area right here. There's going to be breakout orders for traders going short underneath of that. There's going to be profit-taking orders, and there's going to be traders looking to position themselves in the opposite direction if this level gets broken. So we've come down from Friday's high. Now the other concept that we talked about, if we're looking at an average weekly range, in this particular case of 260 pips, the first thing we want to look at is this is one level of drop. This is a 50 pip box, so that's one level of drop. If we were to project movement in 50 pip increments, we might think level 1, day 1, level 2, day 2, level 3, day 3, level 4, day 4. It keeps falling before the market pulls back inside. That's 200 pips. So as the week evolves, we have lower highs and lower lows. We go into the next day, median price. We want to be thinking possibly sell high, drop. Now the market moves around this price, but what that's doing is painting us a high and a low. When it's consolidated that tightly, it hits the stops on the downside, hits them on the upside. There was news on this particular day which created this gap and the spike upwards, and then the movement back down. But again, just thinking in terms of average daily range, not worrying about where we would have bought or sold, but average daily range. We've got 1 box, 2 box, 3 boxes, 4 boxes. That's 100 pips. We said that the pound's average daily range was 100 pips. So if the market starts to move down into the next equity session, and we've already got 1, 2 levels of drop, in your head you may want to start thinking that if this level is broken, we may have another 50 pips of movement left in this move down to the downside. So the market, and this is Wednesday, again the pink line is a Monday. We head into Thursday's session. We mark off our highs and our lows, and we can see on Thursday that the Asian range predominantly is between the numbers. It breaks out, comes back and hits the stops up high. At this stage again, we've got Monday down, Tuesday, Wednesday down. The projection is that we're looking for a stop hunt high to short that move down. We want to be selling high. And in this particular situation, the market breaks down before it comes back and hits a stop hunt 25 pips above the low of the Asian range for the continuation down to the bottom. Now, as we get closer to the end of the week, we've got 1 day, 2 day, 3 days down, 4 days down. It's important that now we start looking at how far the movement has been for the week. We said the average weekly range for the pound is 260 pips. We've had, if we go in 50 pip increments on the other pairs, the pound New Zealand, pound Aussie, I use 100 pip increments because there's more volatility. With the pound, 200, 250, somewhere in that range. But if you can see that the pound is trading in 50 pip boxes. So we have one level of drop, two levels of drop, three levels of drop, four levels of drop. And then it consolidates going into Friday. It pulls back inside. And again, we'll draw our Asian high and low. And you can again see that it's trading between the numbers. And the pound popped back inside of the double zeros box. So again, just thinking in terms of numbers, if we have zeros and 50s, okay, we've in this particular case, this was the middle of the move down. Monday, Tuesday, Wednesday, middle of the week, trending day down, extended the move. We come into Thursday, we're at double zeros, and again, the market broke down. It gave us an early indication in the Europe changeover before London opened at the equities open. It stop hunted high into the box to continue that move down. But then it came back in on Friday inside of the double zeros at the London Open. And then again, 50 pip boxes moved up a level. So we have off the bottom, one level of rise, two levels of rise, and we finished the week in consolidation above the 50 pip box. So average daily range can give us some feedback on looking on Friday, one level, two level, three levels, four levels of rise. That's 100 pips. As we headed into the U.S. session, that trend, there was, again, we consolidated prior to the equities open. Traders have shorted this. New York has opened and just continued that move up, 50 pips up. The other thing we talked about earlier this week was identifying where profitable trades are. So if we look at each session, where was the profitable trade? You can see that before the week ended, the market has gone back and cleared out traders that were profitable anywhere in these areas. And we sort of have a running joke that nobody gets a free lunch, meaning that if you're in a profitable trade, often by the end of the week, the market will do everything it can, either by the end of that week or into the next week, to make sure that any of these profitable trades have been either stopped out at break even or stopped out with a loss. But the biggest concept in yesterday and today's video was to identify the Asian range, whether it's between numbers or around numbers. That can give us an idea, plus or minus 25 pips of possibly either a stop hunt area or a target for the market to move towards at the equities open. And then we talked about Asian boxes that are trading around the numbers also as an area to identify as plus or minus 25 pips for stop hunts or for the market to reverse off of. The idea, again, is to stay out of this area. We don't want to get caught. We want the market maker, the smart money, whatever you want to call them, the banks, to show us their hand prior to us participating in the market. Getting in early, getting in on a hunch, getting in on some kind of, price action pattern may work out for you. But ideally, what we want to do is identify the high and the low as potential areas for us to either be positioned near and then wait for the equity opens to either issue a breakout and a stop hunt, or a stop hunt on either side before it continues the move. And then, of course, identifying our average daily ranges as possible areas of where the market may have looked to be turning or reversing. And again, usually that will occur at the equity opening times, London, Asia, London, and New York. And then using round numbers specifically to identify high probability areas of where we can be entering the trade and managing our risk for an asymmetrical profit target. Ideally we we want to be targeting, at least 3-4 times our risk on these trades using numbers. And again, coming back to just some simple concepts, looking at the levels of rise and fall, like for example, if we look at the pound New Zealand, we're looking, if this is the Monday separator, obviously the market moves around. We've got a 100 pip box, so we go 100, 200, 2 levels of rise. We said that the pound New Zealand's average weekly range is about 400 pips. So we're thinking 100, 200, oops, it drops down 100, 200. We're inside of a 200 pip box now, but then we go level 1, level 2, level 3, and does 300 pips before it pulls back and consolidates into the close. Now this is, again, just some things you want to be thinking about as we head into, you might have missed getting in somewhere in here. This was difficult possibly to read or to trade, but as we headed into the equities open for New York, you might have been thinking to yourself, 1 push, 2 push, 3 pushes into the open, at the top of a double zero box, at the end of a 300 pip week, 3 levels of rise, 1, 2, 3. There may have been a short position up here for traders who were trading off of either the break of this bull candle or on a shorter time frame for 50 to 75 pips down, which was designed again to stop out the traders who were long off the London session. So just looking again at levels of rise and fall, if we look at the pound New Zealand, roughly 180 pips. So we got 50, 100, 150, 200 pips. If our average daily range is 180, again, we may have missed the low of the day in Asia. We may have missed the middle of the move in London. But as we get towards the end of that 200 pips, we're underneath the double zero box. It's consolidated and gone sideways. They drag traders up one last time right at the New York Open before they drop it down 75 pips to hit the guy who was long at the London session. So just thinking simple, traders, stay out of the inside, work from the numbers, wait for the equity opens, stick to a tight window for your trading time. If there isn't something there, don't worry about it. Come back later in the session. If you miss something on a particular day, don't worry about it. As you can see, there's plenty of trades, and ideally, if you're targeting 1 or 2 really good trade setups a week that fit your criteria in that window, that are really simple, that you can reproduce, that show up every single week. It's not about trying to grab every swing in the market. It's about targeting positions where you can manage your risk really tightly with a simple analysis, not analysis paralysis, a simple method to enter and exit the market, to trap profits and keep your risk really tight, and reproduce that over and over and keep scaling it up and trading it bigger. So hopefully you got some value out of today's video, traders. Again, just continuing from yesterday's video, talking about average ranges and then identifying the Asian box, whether we're inside of numbers, targeting previous areas of, we're going to be talking about this in the next video, the importance of these daily highs and lows. And again, as we peel off the onion layers, even though it sounds simple, we talk about the high and the low, the equity opens, round numbers, 12 candle rules, and now we're looking at using other parts of the numbers to work to our advantage over the course of the week. And again, the idea is about staying outside of stuff that potentially could trap us into 50-50 areas where we enter into the market and we sit in a position, for an extended period of time without it going anywhere, or potentially being caught into something that we end up getting stopped out on, or having a small loss, or obviously you can see in some cases if traders were trading this thinking it was going to go down somewhere in this area, maybe on the break of the swing at the Europe Open, they potentially could be sitting in this all the way back up to last week's high. Or traders that have gone long somewhere up here and held on to that, lifted their stop. And you'll notice that the more you start to study this, that when you're caught in the wrong position, the market very rarely gives you a chance to get out. If they go back up to a certain point, they allow a lot of losing traders to get out of the position without a loss. So once they lock in those losses, they shift away quickly. And they lock in traders in the wrong direction, they shift away quickly. Just something to think about. So hopefully you got some value from today's video, traders. Average daily range, median price, the Asian box, looking at the average weekly range in terms of levels of rise and fall. Each day, looking at your average daily range as you head later in towards the end of the day into the New York session. If you've missed the low of the day or the high of the day, that doesn't mean that you're not going to get an opportunity in New York for a move back in the other direction, or even for a continuation. So stay disciplined, stay focused, traders. Keep getting better. Keep it simple. As you can see, there's a lot of information that, from the outside looks simple, but as we peel back the layer on each one, there's a lot of detail there in terms of how we can get better at this. Have a great weekend, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.